Sir, good evening.
Good evening.
Can you hear me?
Yes, sir. Yes,
Yes,
sir.
sir.
Yeah. Sorry, there was some technical disturbance.
Shall we start, sir?
Yeah, we can start.
Okay. Thank you, sir. On the behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the webinar series on intricacies of the cost audit and cost record rules on different sectors. Our today's session on mining sector and speaker is CMA Niranjan Mishra, sir. I also welcome our Western India Regional Council Chairman CMA Chaitanya Lakshman Rao Morir sir and Treasurer CMA Nanti Shah sir. Now I request Chairman sir to please address the participants.
Good evening, all. I'm very happy that we have started this series of costing and cost audit on different industries. This was a very much long demand from the members of institute that they are very eager to learn what are the processes in the cost audit in the different industries, because not all the practicing cost accountants are doing cost audit. Many of them are just working in other fields also, but they are also very much eager to learn the process of cost audit. And as we all are aware that the process of the cost audit is different in different industries, though we have to file the CRA1, CRA2, CRA3, but the process is pretty much different, followed in the industry as well as within company also the process get changed. So that is the reason we kept this series on cost audit and costing practices in different industries. And I'm very happy that our former council member Niranjan Mishra sir accepted our invitation, and he is delivering lecture on the cost audit in mining industry. Mining industry, for cost auditing mining industry is there since long time, and very few cost accountants are doing audit in the mining industry, and it is very interesting industry to know. So I'm very sure that Niranjan Mishra sir will give all the insights of this mining industry, and we will gain the knowledge. Thank you very much.
Thank you, sir. Now I request our Treasurer CMA Nanti Shah sir, please address the participant.
Thank you, Pujanka madam. Am I audible?
Yes, sir.
Yeah, I just joined this session because Mishra sir is also guru to us. We have seen him excel in so many areas and guide us youngs to CMAs. So, and for mining, obviously, he is the natural choice. So, it is a pleasure that the PD committee has arranged such a series, because we, even after 10, 12 years, get to learn so many things from our seniors. So with this, I think I'll not get between you and Niranjan sir. So Pujanka madam, you can proceed with the.
Yes, sir. Thank you. Thank you so much, sir. Our today's speaker is CMA Niranjan Mishra, sir. He holds the Master degree in Commerce, Bachelor of Laws. Also, he is a fellow member of the Institute of Cost Accountants of India and Indian Institute of Surveyors and Loss Assessors. He is a practicing as a cost and management accountant since 1993 at partner of Ms. Niran and Company Cost Accountant. He is a consultant to various companies in their cost reduction and cost management programs, trainers on cost records, cost accounting system, cost audit for national and international organization. Also insurance surveyor and loss assessor since last 26 years. He is a council member of the Institute of Cost Accountants of India for the period 2015 to 19 and 2019 to 2023 term, and selected for the following committees as a chairman or a member of the Taxation, Cost Management in Government and Public Services, Corporate Laws, Professional Development Committee, Cost Accounting Standards Board, Cost Audit and Assurance Standard Board, Technical Cell, Management Accounting Research Foundation, etc. He is also associated with some reputed non-government, non-profit social organization in the capacity of members or advisor. I welcome Niranjan sir, and now I request sir to kindly start the session, sir.
Good evening, madam.
Good evening, sir.
my hearty best wishes to the participants, members, seniors on this new year. So this is the first webinar, I think, from the WHC side or for the institute side on this app topic, cost audit and cost records. This is the core area. This is the backbone of our profession. So I am thankful to the Chaitanya Morir ji, very dynamic person and a very young and dynamic person, chairman of the WHC, Mr. Nanti Saji, and in the absence here, Sri Arindam Goswami ji is my younger brother. So we have discussed a long days back to start this session on the cost audit on the top on the industry specific, and it is mostly essential for the practitioners. And during the audit period, we are unable to grasp the areas, grasp the points, and basically all will be busy from April to October, from financial to till the filing of the report in the XBRL. That's why I told him so that if you start in the off season, so that more and more participation will be there and everybody will gain out of the subject. So this mining industry cost records and cost audit are not new to us. It was started as early as in the year 2001. So we'll go to that afterwards in the next slide. But before starting from the my deliberation, I wish to say that this mining industry is the lifeline of the infrastructure projects in the country. And not only lifeline of the infrastructure projects, but it also improve the social conditions and social development in the rural people and the tribal people, and it also increase the livelihood of the rural people and tribal people. Because I am doing this audit or record maintenance or the consultant to various mining industry, having exposure in the coal mining, I don't know, chromite, limestone, bauxite, manganese, chondrite, since last 15 to 16 years. But what I have seen, the livelihood of the people, those are living in the mining area last 15 years back, now they have improved. Now they are going to college, and most of the people from the rural area now they are doctors, engineers, and I have seen also some people, some members are also from this tribal area, those are cost accountants and chartered accountants. So and this is there is no input. Mother Earth, like nature, has given us a lot of input for our sustenance and livelihood, and this mining is one of them. And without input, it gives us immense profit, immense revenue to the government, immense revenue to the corporates, those are doing the mining activity. So, and what I feel during this 4 days, four topics, another point is that coal mining. So, Mr. Alokesh Datta, same Alokesh Datta, he has a lot of exposure in the coal mining area. He will speak on the subject. So, I will not touch upon the coal mining. I'll cover the iron ore, chromite, and overall in the mining sector, and what are the intricacies in the maintenance of cost records and some case studies, and my observations during last several years of audit. So I am presenting my slide. I request everybody to participate if required after 1 or 2 slides. If anybody wants to ask any question, I'm open to respond. If I'm unable to respond, because I am doing since last 15, 16 years, but I am not still expert. And on the other side, the members are sitting there, they may be expert. So I request them, if anything is in mind, they can ask the question. And if possible, I will reply at the end of the webinar, or I will respond afterwards. Time is very short, so let us start. So I am starting my PowerPoint presentation. Please hold on. Just a minute. Is it visible? Hello?
No, sir.
Not visible, na?
No, sir.
Okay, please hold on.
Sir, please share your screen. Just put the click the arrow button and then choose the screen. It will be visible.
Just a minute, sir. Just a minute, sir. I think something went wrong. Just a minute. So this is share. So that is in my desktop. Let us share. Just a minute, sir. Something went wrong. Share desktop କାଇଁ ହଉନି ସେଟା desktop ଅଛି ସେଟା କୋଉଠି କଥା କରିବି
Yeah, I think you're sharing.
Huh?
You can just ask if you're sharing.
sharing କରି ପରା
You are sharing right now.
ହଁ ସେ ଦେଖାଉନି ସେଟା କଣ ସେ କରିବେ
Wait. Just ask if you can see.
Is it visible?
Yes, sir.
Okay.
Yes, sir, visible.
Is it visible now?
Yes, sir. Yes, sir.
Okay. Thank you. Sorry
Okay.
for. So this is the topic, webinar on intricacies of cost audit and cost records in the mining sector. So I have divided this total session of 2 hours, maybe another 1.5 hours, into this in 9 points. Number one is introduction, second is overview, third is applicability to mining sector, forms and annexures, key activities involved, then approaching cost audit, roadmap and practical way, cost items need special attention, my audit observations and challenges in the mining sector. So these are just introduction. We know every because most of the participants are doing the cost audit, so we know about the cost audit. Just I have put a definition. The detailed checking of the costing system technique and the accounts to verify their correctness and to ensure adherence to the objective of cost accountancy. Just I put here. Then this overview and the company's cost records and audit rule 2014 are applicable to every company registered under the Companies Act, which are engaged in production of goods or providing of services listed in Table A or Table B. Because everybody we know that, but quickly I am going back to 3-4 slides so that it will brush up our mind and we can recollect the memory. Table A, regulated sector, 6 sectors covered. We know everybody: telecom, electricity, petroleum, pharma, fertilizer and sugar. Table B, non-regulated sector, there are 33 sectors. So next come to the section 148 of the Companies Act. Subsection 1 speaks about the cost accounting standards. Then audit on the basis of turnover. We know everybody there is a threshold limit for regulated sector and non-regulated sector. Cost accounting as cost auditor, auditing standards is applicable. We know there is a 4 cost audit standards which is applicable to the cost auditor. Standard 101, 102, 103, 104. We know everybody about the cost audit standards, which became mandatory for the cost auditors. audit in addition to 143. That means the company, those are conducting the audit under section 143, they have to, if they are covered on the purview of cost audit, they have to do the cost audit under section 148. Auditors rule are applicable and report to the board of director. So where there is a audit committee, there is an audit committee, then the report will route to the audit committee, then it will go to the board of director for their authentication. So that is applicable here. If there is no audit committee, report will go directly to the directors. Then 30 days to be submitted to the central government. Suppose the cost audit is completed, the auditor submitted the report and annexed to the audit committee. Audit committee will discuss on the cost audit report. Then you will forward the report to the board of directors. Then after the board of directors approve it, then they will authorize two directors to authenticate the cost audit report. After which that will be filed with the Ministry of Corporate Affairs in SBRL within 30 days from the board of approval by the board of directors. But in no way the date should be the approval. No way should be exceeding 180 days from the commencement of the financial year. That means by 27th September, the cost audit report has to be approved by the board of directors, and within 1 month it has to be filed. Suppose the board of directors approve on 1st of August, then the 30 days will start from 1st of August. So there is some doubt in some practitioner's mind. The 180 days means maybe 6 months. No, that is 27th September. Secondly, 30 days from the approval of the report by the board of directors, not from the 27th September. The 30 days will be count from the date of approval of the board, not from the 181 days. Then cost auditor has to give the information if it's called by the Ministry of Corporate Affairs or cost audit branch. And we know there's a punishment under section 147, both for the company and both for the auditor. Both for the company, every officers of the company, those are involved in the process of cost audit, and auditors. So we know there is stringent punishment. So those are actively involved in the practice and profession. They might have noticed in last few months notices are coming to the auditors and the company also. Those have not filed the report in SBRL in time, or the auditor have not completed by the auditors in time, or whether the company is governed the cost records but not audit, whether they have maintained the records or not, they also got the notice. Because now the ministry is synchronizing the accounts, when the AOC4 is filed by the company with regards to the financial accounts, then they are picking up the companies. Those are covered on the purview of maintenance cost records and cost audits, but not conducted so far. So from that they are sending notice to the company, and where the cost audit is appointed for the company in CRA 2, but by the due date they have not filed the cost audit report, they are also getting notice, and both the company and the auditors are getting notice. So since we are our practitioners is very few, and our profession is always challenging, and other than in comparison to the CA profession, the accounts and these cost accounts is very challenging job, and always ministry is keeping eye on this profession. So it is our responsibility to advise the company to complete the records, so that we will complete the audit in time, and we also file the report in time within 30 days of the approval of the cost audit report in the board of directors. So the legal provisions, section 213 regarding the books of accounts, section 141 qualifications and disqualifications, section 144 list of prohibited services. I have also noticed during my this practicing career, some cost accountants are doing the cost audit. Along with that, they are also doing they are also rendering some services to the company, like maintenance of cost records. And some sorts of outsourcing of financial services, 1-2 type of services they have rendered. Even also after giving the declaration while continuing the cost audit, there are some auditors are doing also the fixed asset audit and inventory audit. So if that is an internal audit what is there, it is very difficult, and we should not accept the assignment in addition to the cost audit, internal audit, or any audit assignments. It is better not to accept other than the certification work, related certification work, and what is not prohibited as per section 144. So while conducting the cost audit or while accepting the assignment of cost audit, we have to, if company is offering any more services other than the cost audit, we have to report the section 144. We have to interpret the section 144 spirit. Then we'll accept the another assignment. Section 143, powers and duties of the auditors. Here CMA and CS both are included. Another point, interesting point, section 139, rotation of auditors not applicable. You see, in case of financial audit, the auditors are appointed for 5 years. But here rotation is not applicable, because you see here the auditor is appointed each year, every year. Because though some companies are appointing the auditors for 3 years, but they have to file the CRA2 every year. So I feel that's why rotation is not applicable. Secondly, there is a threshold limit of the turnover. Suppose the company is coming to the purview of cost audit in the current financial year, and in the next financial year, his limit is turnover limit is less than the threshold limit. In the third year, it will not be covered on the purview of cost audit. I think, I presume for this 1-2 regions, the rotation of auditors is not applicable here. And here are the salient features. Then come to the applicability. Now we'll slowly we are entering into our today's webinar. That's the applicability, cost accounting records, mining and metallurgy rules 2001 on dated 24th April 2001 only for non-ferrous metals or minerals. You see, this our profession get into this cost account record maintenance by virtue of the rules 2001, and interestingly only non-ferrous metals were covered. So non-ferrous means chromite, bauxite, limestone, chondrite, all these are covered, but iron ore, manganese, these were not covered in the said rule. But however, in the rule 2011, the company's cost accounting records 2011, which are issued on 3rd June 2011, it was covering all the metals and minerals, both ferrous and non-ferrous. But the company's cost records and audit rule 2014, which are issued on 30th June 2014, mentions the maintenance of cost records and the cost audit by the mining industries. So this is the cost records. We know if overall turnover from all its products and services is 35 crores or more. Suppose you see here one company is producing or processing or manufacturing 2 products. One product is covered on the purview of cost audit, and another product is not covered on the purview of cost audit. The product which is covered on the cost audit having turnover of say 1 crore, even if there is 1 rupee he is getting from the covered product, and 34 crores 1999 is getting from the non-covered products, then maintenance cost record is applicable. So here there is a law. So if company is turnover is more than 35 crores overall turnover, it comprises both covered product, not covered product. Then if the turnover from the covered product is very negligible, then maintenance cost record is also applicable for the company. Then come to the cost audit. Here the same thing, regulated sector 50 crores or more, non-regulated sector 100 crores or more. So here turnover criteria is 25 crore minimum regulated and 50 crore maximum. 25 crore is from the covered product and 50 crore is the overall turnover. Similarly, in non-regulated sector, 35 crore is the covered product and 100 crore is the total turnover. Then if the both conditions are satisfied, that means the company is having 35 crores turnover from the products covered on the Paribaha cost audit, and the company's overall turnover is 100 crores or more, then the company is covered on the Paribaha cost audit for the non-regulated sector. That is our mining sector. Today we are discussing on this. But there is the exception. If the mining sector is in SEZ, that is not quietly possible, and foreign exchange receipt is less than 75%, and is a captive power plant or any captive consumption, then mining sector is exempted. But here only forest receipt and a CPP may be come into force if company is excavating ore and raising ore, and maximum more than 78% is exporting, then it is not covered on the Paribaha cost audit. That is not also possible, because now government has done some regulatory, government mining though not a regulated sector, but government has introduced, forced the company, and those are having mines, maybe merchant mines, maybe auctionable mines, they have to go for the captive plant, not only for sale. They can only not sell, they can also they have to produce, and they have to either sell their product domestically or they can export the product. So here they are the SETA codes for the ores and mineral products. They are SETA codes, we know they are applicable for the companies. These are the basic things, so we'll not discuss on that. CRA 1, CRA 2, CRA 3, CRA 4. This is the cost audit report formats. And here another thing is coming, why I am highlighting your part B. Part B is applicable to the mining sector because this is one, though that is not a manufacturing sector, but is similar to manufacturing. So this is part B applicable. And B1, suppose one mining company or mining industry or one mining company on the government of Odisha or any government or state government or central government. So they are raising 3 to 4 products. Say one company is raising iron ore, chrome ore, limestone or bauxite. So they have to prepare B1 separately for each product. Similarly, B to be prepared for each product separately. So similarly, material consumed to be prepared separately for each product. So B1, B2, B2A, B2B, B2C, all these are to be prepared separately for each category of a product. So in part B2C, there is industry specific operating expenses. So here the company is including OBR cost. You know, OBR means overburden removal cost and mine closure cost. And OBR cost is the about 25% to 30% of the mining cost, and mine closure has an impact of about 5 to 6% cost, total cost on the cost of the mining. These are coming on the industry specific operating expenses, part B to C. Similarly, for which B is applicable, similarly we have to prepare the C. C1 quantity information for each services, C2 average cost statements for each services or each products. But here C is not applicable since we are in the mining sector. For us, B is applicable, and B and C are same, more or less same, but B for manufacturing sector, C for service sector. Now mining industry. I in my opening remarks, I have told you this is one of the major economic activity which contributes significantly to the economy of India. The gross domestic product GDP contribution of the mining industry varies from 2.2% to 2.5%. But going by the GDP of the total industry sector, it contributes around 10% to 11%. So this is the GDP. I am talking about the GDP. GDP means the consumption of the industry, consumption of the consumers. But coming to the revenue percent, if we see the government is getting royalty, then DMF and NMT. These three are the basic source of revenue for most of the states. Like I am giving the example of Odisha. In Odisha, the government, if you see the DMF in up to 31st October 2023, the accumulated DF collected from the various mining industry pan India, it was about 84,884 crores, and out of which Odisha share for DMF was 24,596 crores, about 29% of the total DMF collected pan India. If you come to Chhattisgarh, it is about 14%, Jharkhand 14%. So if you see the state like Odisha, Chhattisgarh, Jharkhand and Rajasthan, and next to Madhya Pradesh, they are the revenue of the government from the non-tax, that is non-tax revenue from their own state. Non-tax revenue from their own state in these 5 states is more than 10%, and Odisha about 29%, and Chhattisgarh about 14%. This is a DMF. Similarly, NMT, DMF is the District Mineral Fund, and NMT is the National Mineral Exploration Trust. So to explore the mining projects pan India, central government has constituted one NMT. So if you see the percentage, then royalty is based on set percentage of revenue, and 30% of royalty is the DMF, and 2% of royalty is the NMT. 30% of the royalty is going to the concerned district mineral fund. There is a trust set up in each state. So they are looking after the periphery development. They are looking after the sanitation, social development, education, health, and afforestation, like your drinking water facility. All these things they are looking, or a road, construct the road in the mining area. So they are looking after all these activities from the DMF at the state level. And NMT means the money is going to the NMT, and that money is utilized by the NMT, National Mineral Exploration Trust, for exploring the projects, mining projects pan India. And royalty is the major revenue for the states where there is more mines. You can take the example of Odisha, Chhattisgarh, Jharkhand, Rajasthan, for that owns non-tax revenue other than the share they are getting from the central government on their this coal and other basically coal. So now coming to the mining, there are 2 types of mining. One is open pit mining, or we can say open cast mining. So the first picture is the real view of one iron ore mines. There is open cast mines, and the second picture is the example of one underground chromite mines. So first of all, you see this is the surface mining technique that extracts minerals from an open pit in the ground by developing benches. So if you see the steps, these are called the benches. They are the benches, and at the bottom there is ore. So and they have to drill and blast. First they have to prepare the benches, steps. So as per the terminology, the wide and height, the height and width of the each bench is equal. So if you see the step is 4 meter height, then the road means this bench will be 4 meter. So this is equal to the width and height of the bench is equal. Then in the second point, you can see the mining operations carried out under the surface using shafts, slopes, tunnels, or other openings. So this is the view of one underground chromite mines. We are the auditors of that underground chromite mines in Odisha. That is the Banguru chromite plant of Odisha Mining Corporation. So they are very old plant, old mines, and these mines. First of all, this is they have prepared the shaft. So through the shaft, they have prepared the staircase. So we have to go to the underground, and after entering the underground, the similar procedure for the open cast mines: drilling, blasting, and separation. Then through the winder, it will come to the top of the mines. So what are the part before going to the cost records or cost audit in the mining sector or the intricacies involved in the mining sector? So first of all, we have to know what are the activities involved in the mining. The mining, the activities are I have prepared into two parts. One is pre-production, then production. Third is post-production. And post-production, though this is not related to mines, but this is the part of mining activity. You see, in pre-production activity, that I have prepared in two parts for open cast mining, one column, and for the underground mines, second column. First column, you see receipt of title of mine, assessment of reserve, core drilling, mine planning, forest diversification, environmental clearance, CT and CTO. CT means consent to establish, CTO means consent to operate. So these are the pre-production activity. Pre-production activity for the open cast mining. If you see, if you compare the pre-production activity for the open cast mining and the underground mining, there's a slight change. You see, in the fourth point, your forest diversification, environmental clearance. Here, another point, access construction. Access construction means, I have seen in the previous slide, that means now there is established fact that there is a ore at this level, or there is ore available, this reserve is available. So first the company has to prepare the construct the access, how to access to the mining bench. So they have to construct the access like a shaft or slopes, what I have shown in the previous slide. You see, shaft, slope, tunnel, or other opening, first they have to prepare. Then they have to apply for CTE. CT means consent to establish, CT means consent to operate. So each and every company has to apply for the CTE with this mine plan, then a reserve basic assessment of reserves, then how they will diversify the forest, how the environment will be protected. They have to apply to the pollution control department for the environmental clearance. Then after that, if all these conditions are satisfied, then the mining company will get the CTO, consent to operate. So when the company will get the CTO, consent to operate, then production activity will start. So production activity will start with site preparation and bench development. I have seen the previous slide, the bench development. Bench means first they have to make an access to the ore level. That means they have to prepare the bench height and width are same, and they have to prepare one site. How from the safety side, from the environment side, they have to see that. Then they will go for then they will first explore. So explore means exploration. One is exploration is core drilling. Second exploration is your to see how much type of reserve and how much reserve of the respective grade is available in the respective area. So for that they will go for the exploration. So then after exploration they will go for the drilling and blasting. Then drilling blasting, then they will first overburden will come out in chrome and iron ore and coal. The overburden content is vary. Again also in iron ore also the overburden will vary. The 65 Fe content having 65% is the best iron ore. So similarly, up to 40 grade, there is a up to 40 grade there is called your overburden that is not applicable for the any industry. So iron ore beyond 40%. So 65% is the best, and 40 to 65% if the grade is less, then with blending they will make it usable with the 63 or 65%. So at that time overburden will be separated. Then excavation, screening, and crossing. So you see the 3 points. Though these are you can consider the one activity. So after drilling blasting, we can find the ore. Then they will make the sample analysis and they will go for the excavation. After excavation, if the higher volume or the big size of the ore will come out, then it will go for the screening. And if it will not pass in the screening, then it will go for the crossing, then again in the screening. So after crossing screening, it will come to the quality control department for sampling. Sampling which grade. So as per the sampling, that will start in the stockyard as per the grade. And this sampling is of two types. One sampling is internal, one sampling is external. Internal sampling will be done in-house by the own quality control department of the company, and the external sampling will be done by the respective government department or the agency deployed by the government department. Because government will get the revenue in terms of royalty if the grade is high, and if the grade is low, government will get low revenue in form of royalty. If you all recollect why the Saha Commission has been set up 16 years back, why the Saha Commission was set up? Because at that time the government was losing the royalty, government was losing the revenue due to some manipulation or some manipulation in the sampling or misappropriation of the or manipulation or what is that? Misappropriation or embezzlement of the royalty, or dispatching the good grade of ore but paying less royalty. That's why now the sampling is of two types. One is internal and external, and if the company has to pay the royalty as per the external sampling. So to avoid the blockage in the dispatch, to avoid
Sir, you are on mute. I think your voice is not audible.
Niranjan sir, you are not
Niranjan
audible.
sir.
I think your voice is muted.
Niranjan sir, please unmute yourself.
I don't think he is being able to hear us. Let's put it in the chat box.
Sir, I am audible. Audible.
Yes, sir. Yes, sir.
Yes,
Okay,
sir. You are now audible.
The screen. Are you looking to the screen?
Yeah, the screen is black now. You kindly share the screen.
Okay.
Yeah, it's visible now. Perfectly
Okay.
all right, sir. You carry on.
Okay. So, just a minute, sir.
Something, now it's all right, sir.
Is okay?
Yes, sir.
Yes, sir,
Okay.
it's all right. You carry
And
on.
how, since how long I was not audible?
Maybe for last 3-4 minutes.
Okay, now I am audible, na?
Yes, sir.
sir.
Yes, sir.
Okay.
You are absolutely
So,
right.
लास्ट थिंग है स्टार कमीशन, उसके बाद आपका नहीं सुनाई दिया था.
Acha, excavation, you see, excavation, screening and tossing, that all three are the interrelated activity. After blasting, the company has to go for the excavation. So excavation means raising the ore. Size of the ore may be big. So if it not pass in the screening, then it will go for the crossing, then again screening. So these are the interrelated thing. So after screening, the final ore will come out. Then company will go for the sampling. Sampling are of two types. One is internal sampling and next is external sampling. In internal sampling, company is having their own quality control department. They will see the grade of the ore, various grade of the ore, and accordingly they will stack the stock in the stockyard. And external sampling means the sampling will be done by the external agency or government departments, by the government departments. So to avoid the disruption in the sales or dispatch, the company what is doing there after stacking in the stockyard, they will intimate to the mining department or the deputy director mines or the concerned mining government agency. They will come and they will compare the grade of the ore stacked in the different stacking points. So this is the things. Then OMT and the transportation to the stockyard. Then exploration. The exploration for two types. I told you, active mines or the progressive mines. The stacking of ore and dispatch. So these are the 67 points. Those are very much vital. Starting of the receipt of the title of mine till dispatch of the ore at the OB reach. Then another point is the post-production activity, that is mine closure. But in case of mine closure also applicable in the production activity, because mine closure of two types. One is progressive mine closure. Second is permanent mine closure. So progressive mine closure also moves concurrently with the production activity, and post-production activity mine closure means at the end of the mining lease, the mine closure is done. So these are the activity for open cast mining and underground mining. Then come to the mine closure. We have discussed now the mine closure, which is this is the major cost for the mining activity and mining industries, and it constitutes about the 5 to 6% of the total cost of the ore. Progressive mine closure, it involves ongoing planning and implementation of measures to minimize environmental impact, added safety concerns, and gradually reduce the footprint of the mining operation. This phase occurs in active mining operation. So what I have told you, the mining closure is of two types. One is progressive, is part of the production activity. It moves concurrently with the production. So it involves ongoing planning and implementation of measures to minimize environmental impacts. You see, suppose in case of bauxite mines, if anybody has done the audit or any concerns to the bauxite mines is the progressive mines. So this is available not in abundantly, it is available in the benches, say 10 feet or 15 feet or 30 feet wide, long stretch. So in that case, what is happening? First, they are removing the overburden, they are stacking in one point, and more and more they will move forward. Then where there is the overburden will be filled up. The overburden filled up in the overburden gradually, and they will start the planting of the trees, so that it will be as usual before the taking of the mine on lease. So this moves concurrently. Again, safety concerns, solar fencing or any so that the wild animals or any forest animals will not be harmed. So that they will go for the solar fencing and other safety measures. They have to prepare the boundary wall or any checkpoint they have to maintain, so that safety measures will be taken. Then forward mine closure means after the mine is closed totally, then they will go for the mining closure activity. So now then you can tell, if progressive mine closure or permanent mine closure are not much of this thing, then how this is accounted for? You see, there is a IBM, Indian Bureau of Mines. They decide the mine closure cost per hectare, and it is decided looking into the various activity, geotechnical constraints, economic risk, then socio and environmental challenges. What is there for the mining, and they decide the price. Indian Bureau of Mines decide the price. Say the per hectare mine closure cost will not be same in Odisha if you compare with the Rajasthan, because 3 to 4 factors involved. 3 to 4 factors have a lot of impact to decide the mine closure cost per hectare. So though activity will end, the activity will start at the closure of the mines or after the close of the mines, and progressive mine closure is very less impact, and permanent mine closure has a more impact. But the cost will be there is provision for the mine closure in the cost and as well as in accounts concurrently. Otherwise, what will happen? If you not book the cost, if you not make the provisions, at the end of the year, there will no turnover, and we have to book the huge cost. That's why this IBM concept came maybe 10 years before. Before that, it was not there. So it started 10 years back. So they have decided the cost of mine closure per hectare, state-wise, area-wise, location-wise. I am giving the one location in Odisha also, the same location. Even in Keonjhar, one there is a district, the mine closure cost per hectare is not same as another mine closure cost in a mine in a distance of 100 kilometers. So they decide, they see the impact, technical constraints, economic risk, and socio challenges, environmental challenges. Then they decide the rate, and that rate they each year is going to be changed. Suppose, for example, this mining plan, what I have discussed before this slide, this mine plan is given for 5 years. Say in 5 years, there is a provisions how much quantity of ore you will extract, how much mine closure you will make the provision, and how much mine closure will go for the provisioning, for the progressive, and what is the other activity that will be set up in the mining plan. Say after 5 years, say in mining plan, so there is a overburden percentage, overburden to ore percentage they are also in mining plan. So after 5 years, so the company is unable to produce, maybe due to some reason, the desired quality of ore, desired quantity of ore, and some activity is not undertaken, then mining plan is revised. Or say initially the company explores, so company found that this is the ore quantity I will get from the mother shaft. Say, but that quantity, that desired quantity or quality of ore is not found. Then the mining plan is subject to revision after each 5 years. And in at the time of revision of the mining plan, then there are other conditions like the grade of ore, quantity of ore, mine closure cost, all these things will be again put in the mining plan. So that is ore rigging. You see, this ore is raised in two arrangements. There's one own arrangement or activity. Second is MO or MDO. MO means mining operator. MDO means mining developer and operator. You see, why the difference? Why the company has switched up from own arrangement to MO or MDO concept? You see, we have seen where there's a own arrangement, the company has to engage its own mining assets like dozer, dagliner, dumper, DG sets, shovel, winder. These things company has to engage. And for internal transportation, company has to engage truck or conveyor belt. So, and again for the screening, company has to go for the crusher and screening. All the things company has to engage. So the company, those are engaged in the mining by their own arrangement, in the long run, they have seen the cost is much more because they have to go for the alternative. You see, suppose there is one driver and the driver is ill, then the operation stop. They have to go for the alternative driver. Say it was also very difficult to control the repair maintenance of the mining assets, the fuel consumption of the mining assets, and again, suppose in government company or any corporate there is a strike, then the mining operation has to be disrupted, interrupted. So in that case, and the loading and unloading, there is a labor laws and the labor unions. So company felt a lot of difficulties, and even those are the auditor of Coal India, the Alok Datta sir also tell about this thing, all these things. But those have done the audit of Coal India or any other mines, they have seen where there is a operation by both own arrangement or outsourcing arrangement. The outsourcing arrangement is better because there is a penalty clause. But if you are raising the ore through your own arrangement, you cannot put the penalty clause. You cannot penalize your own employee. You cannot restrict the employees or the assets to move forward. There is certain rules and regulations, and you have to move step by step. But if you are outsourcing, then all these things, all these restrictions, all these impacts will be abolished. So your cost will be less. I have seen in some companies, though the dumpers and DG sets or shovels are very old, they are consuming more and more fuel in comparison to the new assets. and their repair maintenance is also very heavy in comparison to that written value. Till the company is not discarding those assets, because I don't know the region. Maybe due to some ill or malafide intention, the company is not recommending these assets to be disposed of, though they are showing less performance and more cost. So, but this is not, you cannot find this type of cost, extra cost in the MO or MDO activity. MO activity or MDO activity, what the difference between MO and MDO activity? In MO or MDO activity, the company will first approve the mining plan. Then company will explore how much quantity of ore is there, to what extent, the stretch, how much kilometer or how much distance is stretched. Then it will go for the agreement with the mining operator. So mining operator will look into the look after the what are the conditions, mining conditions, the environmental conditions, and the grade of ore available, and the transportation, internal transportation, and the feasibility. Then the agreement is signed between the MO and the company. So MO's activity starts from the drilling, blasting, from the drilling till putting the ore till the stockyard or dispatch point. So here what is happening? All the costs like engagement of machines, statutory, non-statutory manpowers, repair maintenance costs, depreciation, then consumables, all are not there. So here the company has to pay one price, ore raising price, to the mining operator, and it is very less. We have compared two types of company, which one company in the raising the bauxites by their own arrangement, and another company raising the bauxite in their by MO or MDO, and the price is more or less 400 to 450 rupee difference per MT. So region is the only this mismanagement or non-utilization of the mining assets or any other internal matters, but the cost to the company for MO or MDO through MO or MDO regime is less. And if you see the manpower engagement, here only the statutory manpower will be there. Though the activity will be done by the ore raising contractor, MO or MDO, here the statutory manpower will supervise the mining activity. They will be from the company side. Similarly, quality control will be from the company side, because company will pay the contractor on the basis of grade of ore. That's why sampling or quality control will be done by the company, on the basis of which they will fee the buyer and they will pay to the raising contractor raising charges. So this is the thing regarding the MO or MDO. And MDO, what is happening? MO, in case of MO, they'll just go for the mining operation with the existing infrastructure facility. But in case of MDO, they will go for the extra activity like creating more facility, or like railway sliding. Suppose the company is dispatching, the company has facility of dispatching the ore through road at the overbridge point, and MDO, if the MDO is taking the mines for a raising, then there's a feasibility or there's a possibility to extend for the railway sliding. They can go for the railway sliding so that they can dispatch more and more ore, so that in the long run they'll get more profit. Then come to our core area, cost records and cost audits. So before starting the audit or before going to cost record, we have to see in any mining company, these are the main cost centers. Diet mining, that is called the operational cost centers. Then geology, which looks after the exploration, drilling, blasting, and then your afforestation, then environmental protection. All these peripheral development will look after by the geology. Then forest department, then drilling and blasting, sampling and quality control, maintenance, HR, human resources, social, admin, and selling distribution. So these are the basic cost centers we have designed in mining industry. So geology, forest, drilling and blasting, sampling and quality control, maintenance, HR, social, admin, S&D. So these are the cost centers. Then come to the cost components. So the cost components means like our regular cost sheet, the material, these are the departments. So in each department, we have to find out what are my material, what are the utility, what are the repair maintenance cost. We'll go one by one. So then we have to go for the fixed and variable overhead. What are the fixed overhead in the mining industry? What are the variable overhead in the mining industry? And if you see in the mining industry, more or less the vehicle, more or less the variable overhead is very less. If you are raising through the MO or MDO, then all of your expense will be fixed overhead. And if you are going through the overaging through your own infrastructure, then you have to separate the overhead into fixed and variable. But if you are going through the overaging contractor or MO or MDO, then almost all costs are fixed. We have advised some companies to go for the department costing where there is a SAP because we have separated into production, geology, forest, mining. Here are the departments. So we have advised the companies to go for the department costing so that other than the maintenance of the cost records and the cost audit statutory compliance, they can know what are the cost of the departments, what are the various costs in the departments, so that they can compare it mines to mines. They can compare at macro level also. They can also compare one company to other company. So that's why it is very vital, and they can also control the cost in various departments. Then another key point is the inventory valuation. We'll go one by one. Then transfer pricing, capacity determination. So then in inventory valuation, you have seen the stores, spares and consumables are valued on the basis of weighted average method, on the basis of quantity consumed. We know everybody. Then similarly, finished goods are valued on the basis of weighted average method. We also know that. So that is not very. Then important point is the transfer price. You see, transfer price, how it will be determined. You see, in the most of the mining, you cannot find the best grade of ore in each and every mines. So you will find the combination of grade. Say I was giving the example of iron ore mines. Those 63 to 65 Fe is the best iron ore, and it can stretch from the 63, 64, 65. But up to the grade of 40, these are all you can take it as overburden, the dust, जिसको मिट्टी बोलते हैं. बाकी उसका ऊपर माने like beyond 40% till 63%, you can consider the low grade. And both the grades, maybe low grades or the high grades, they are coming from the mother earth. So how will value? There is no extra process. There is no extra process to value the different grades of ore. 40% grade is coming out in the same process, and in the same process also 65% Fe ore is also coming out. How will value the ore? That is a big challenge for the companies, because now that the market is peak, and the company is also selling the 45 or 48 grade of ore, iron ore. So maybe directly or to the blending process. But how will value the ore? Transfer price is separate. If you transfer, first you have to value it, then you have to transfer for your capital consumption. If you have the pellet industry, if the pellet plant, then you can send the low grade of ore to the pellet plant, and there you can prepare the pellet. Similarly, if you have the chrome ore beneficiation plant, you can send the low grade of chrome ore to the chrome ore beneficiation plant or COBP. So that is there. But first of all, as per our CS4, we know CS4, cost of material plus transportation. Cost of material, which is going for the capital consumption, cost of material, then loading at the site, then unloading at the plant, plus transporting the transfer price of the material available for the capital consumption. Then what is how it will be valued? So we have divided a formula. We have divided a formula for the low grade ore. because IBM is fixing the grade of the price of the ore, various price of the various grades of the price of the various grades of ore. So there are two things. If the company has sold various grades of ore in last 3 years, sell price, and the IBM price of last 3 or 4 years, so at the average sell price of IBM and average sales price of our own, then which is less, we can deduct the cost of production percentage. Say to derive the ore of 100 MT, we have spent 1 lakh rupee. So out of 100 MT, 20 MT is your low grade, 80 MT is your high grade. So ratio is your 80% to 20%. So in that case, what will happen? This cost of production will be 20% will be apportioned to the low grade ore on the basis of average price of the IBM price or sales price. So that we have devised. Then we will add the cost of transportation from the mine to the plant. Then come to the capacity determination. It is also a big challenge for the company. We have discussed about the EC. EC means environmental clearance capacity. When the company will apply for the mining plan, in the mining plan they have to apply for the EC. Before mining plan they have to apply for the EC, and the EC means environmental clearance capacity. In this EC, say X MT is fixed. In EC, X MT is fixed. That means 1 lakh million ton. You have to 1 lakh million ton. You have to raise in 5 years. But that EC what is given, that may not be feasible for the company to produce as per the EC. So then company, after 1 year or 2 year production, company will prepare the budget. Either it will be at par with the EC. If the production is in line with the EC, then they'll fix the budget accordingly. Or if the production is less in comparison to EC, because you see, if at the raising time the company is finding the less low grade ore is coming out, then in that case company will go for the less production because it will not fetch more value. So it will reduce its raising point, and it will reduce its raising activity. Then it will go for the revision of the mining plan. It can also possible if the desired grade of ore is not coming out, then they can revise the mining plan before 5 years, before complete of the 5 years of the period. So here normal capacity. So those are having the idea of the chrome ore mining. You see, it's very difficult to excavate, to raise the chrome ore in the rainy season. So basically, in 3 to 4 months, for the 3 to 4 months, the raising of the chrome ore is stopped due to raining, and because the water will be there inside this mining area, so it is blocked. Again, if there's any other activity like any social or any this thing risk, then the activity also stopped. But in the rainy season, iron ore activity, iron production is not reduced; it is also continue. But in chrome ore, it is very difficult to produce in the iron, produce in the rainy season, maybe 3 to 4 months. That's why normal capacity is fixed. Normal capacity is fixed on the basis of the past productions, past 3-4 years production, average production, on the basis of which normal capacity is fixed. And this capacity, normal capacity, we have to fix the normal capacity, because if the company is producing less than the normal capacity, then the fixed overhead has to be under absorbed. That's why company has to determine the normal capacity, budget capacity, or normal capacity. Company to find out the normal capacity. Then production means actual production capacity. Then what are the factors determining capacity? We'll go one by one. Then exploration. So this capacity depends on the exploration of the ore. If in the ongoing operation, in the ongoing exploration or the concurrent exploration, in progressive exploration, the company found the less low grade of ore, more and more low grade of ore is coming out, then they have to feed the normal capacity accordingly. If the production grade is at par with the desired grade as per the mining plan or the EC, then the company also feed the normal capacity accordingly. Here the roadmap, how the audit will be started. That is audit engagement letter, organization chart. Then we have to go for the manufacturing process and process flow chart. Unless and until we know about the organizations and manufacturing process or the mining process, we cannot go for the audit program, because first of all we have to know the mining activity, what are the cost centers, and what are the process like pre-production till production activity, what the manufacturing process, and what the process flow chart. Because in the process flow chart we can find out the cost centers where the activity going on, and what are the costs involved in that process, and what are the key points, what are the cost reduction measures you can take up. So we have to be very well adversed and well conversant with the manufacturing process and the process flow chart. Then we have to prepare the audit program. Then come to the, we have to see whether there is a cost accounting manual exists in the company, and if the cost accounting manual exists, whether that is linking to the chart of accounts. Because in the chart of accounts there is accounting code. If the company has the SAP, company is maintaining the account in the SAP, and there is a CO module, then definitely the cost accounting manual must be linking to the chart of accounts. And then cost centers we have discussed. What are the operational cost centers and service cost centers? Then come to the cost account records, the frequency of maintenance of cost records, and again breakup of the cost into fixed and variable, audit and annual accounts, annual report, internal audit and a fiscal verification report, budget copy. So these are the things we have to first of all see, then we go for the audit. Then come to the practicality. We have discussed earlier regarding the mining plan. Mining plan, what is the mining plan? Mining plan is a proposal for mining on a mining site, including a description of the systematic activities to be used for the purpose of extracting ore and minerals. That means everything is set out in the mining plan. How much, what the total area, what the mining area, that means lease area, and what the boundary of the lease, and how much you can cut the forest, how much you can go for the deforestation. In the first year, how much mine closure activity will take place. Second year, how much mine closure activity will take place. What will the manpower requirement, statutory manpower, what types of equipment you have to engage, what are types of peripheral development you have to take undertake. So these are to be all set in the mining plan. Then mining and EC capacity with the basis of calculation. So what is the mining capacity? We have discussed before that. Having capacity for mining industry means the exercise of that degree of skill, diligence, prudence, and foresight that would ordinarily be expected from a skilled and experienced operator under similar circumstances, adhering to internationally recognized standards. What is that? Suppose I have a mine, and from my exploration activity, I found there is a good grade of ore is available, which will fetch more revenue and more profit to me, mine company. And I am not facing any disturbance locally. My people are good, but one thing is lacking. The machinery or the equipments I am engaging for the mining activity is not standardized. Then whole mission will fail. So that is there. So that means you have to be a perfect operator from all angles. There will be no social disturbance. There will be no challenge from the environment, from the environmental side. There is no challenge. There is no resistance from the government or regulators. And you must have skilled operators. You must have engaged the machines. the benchmark standardized machines, then you can go for the improving the mining capacity. Or else, if you are unable to design the mining capacity, then you have to see the last 3-4 years production with the grades of ore and the time, hours of work and other factors, then you decide the mining capacity. This environmental capacity or EC capacity, EC clearance capacity for certain developmental projects has been made mandatory by the Ministry of Environment and Forest through its notification issued on 27th January 1994 under the provisions of Environment Protection Act 1986. Then come to the next point. After mining plan, then stripping ratio. That is also fixed in the mining plan. Those have done the mining audit, they must have known the stripping ratio. Stripping ratio is the overburden. That means that is more in case of coal, more in case of coal or and chrome, less in case of iron ore or bauxite. So burden overall less. So as per the survey, as per the geological survey, the stripping ratio is fixed, and that is fixed, and that is set out in the mining plan. If stripping ratio means, suppose if we dig one cubic meter of earth, then 20% will be overburden and 80% will be the ore. You forget the grade of ore. In that 80% of ore, maybe low grade, maybe high grade, but 80% of ore will find, and 20% is the overburden. So that overburden is a part of the mining cost, and stripping ratio means 20% is to 80%, 4:1. For 1 cubic meter, 20% is the overburden, 80% is the ore. That stripping ratio is set out. And why this stripping ratio? We are now discussing stripping ratio. Why this stripping ratio is required for the company? Each and every company, they are having OBR policy, overall removal policy, and that is stripping ratio. Why this is required? You see, in some cases, if the overburden is more, if some company is engaged for overburden removal for 9 months, because after overburden removal, company go for the mining activity. So company, first of all, for 9 months, it remove the overburden, and for 3 months, it go for the excavation or raising of the ore. So in that case, suppose it has removed the overburden for 1 kilometer, but from the 200 meters, it has raised the ore. That means if the stripping ratio is not followed, if it is not followed properly, then in the first year itself, we'll get the money from the ore, not from the overburden. So if we book all the costs, that means 1 kilometer overburden cost and 200 meters ore raising cost, then the cost will be more in the first year. Because in the second year, if the company will not remove any overburden, and for the 800 balance meters, 800 meters, it will raise the ore. Then in the second year only, ore raising cost for the 800 meters will be there, and company will get the money for the 800 meters. 800 meters to ore raise from the 800 meters. So in the first year, the cost will be more. In the second year, cost will be less. So in that case, company has to follow the stripping ratio, and there is a measurement. Each year, company has to go for the measurement, how much overburden is extracted and how much ore is raised. So, and what is the ratio of this overburden removal to ore raising, and whether that is as per the stripping ratio followed by the company, or that is in a overall excessive removal of the overburden. In that case, company will go for deferring the overburden cost to the second year. So these are the, and if you go by the CS 23, cost on standard 23, that is overburden removal standards. So you can find it that in detail if you want to know about the OBR or stripping ratio. Then overhead absorption policy, we are discussing that. Suppose one company has a capacity of 100 MT, say, but it produces 40 MT. But it has the capacity to produce 100 MT. It has the adequate infrastructure, it has the equipments, manpower, skilled manpower, unskilled manpower. So company has also fixed overhead, variable overhead, because it is raising through its own infrastructure, own assets, own equipments. In that case, maybe due to some reason, the company is unable to go for the production. In that case, we cannot book the whole fixed cost to this cost sheet, because company is able to achieve 40% of its desired capacity, or 40% of the normal capacity, or 40% of the budgeted capacity. So in that case, the cost for the fixed cost for the less production, the differential cost for the differential production will be under absorbed. So this is the overhead absorption policy. So we know in data consideration that contracts and agreements, mining developer and operator. You see, this contract story is very vital. I have seen while conducting one audit, the contractor was agreed to raise 100 MT of ore. Sorry, 60,000 MT of ore per year from the underground chromite mines. But what happened? This raising was not fruitful, because the contractor has engaged the low quality of equipments, old equipments, and there is some loopholes in the contract, because the company has while entering the contracts into the with the MO, company has not set out the which quality of equipment, which quality of machines, or which standards of machines to be used by the mining operator, so that desired quantity of chrome ore will be produced. That's why the contractor has engaged the low grade of equipment, or the non-standard equipment, for which there's a interruption in the ore production in the underground chromite mines. That is number one. Number two, that means the machinery standard to be fixed, that was not there. Number two, bringing the ore from the underground mines to the surface, there's a winder, and that winder was too old. That winder was the winder has a breakdown of maybe in 1 year there's a 3 months breakdown. So though contractor was able to produce something, that is not possible for the contractor to bring it to the surface of the earth. So there is a fault on the part of the winder. Then come to the separation. There is no clause of the contractor's agreement separation, whether the separation will be done manually. Separation means high grade or low grade. So high grade or low grade separation, so whether the separation is done manually or by the machines, that are not set out. That's why company was engaging the manpower to separate the ore. That means which are the best quality of ore, which are the salvage, which are not low grade of ore. So that was a faulty, that was a loopholes in the contract. Fourth, suppose contractor will engage standardized machines. The winder will be of best standards. There will be no breakdown of the winders. Company will engage the machines for the separation of the ore. But there is another flaw. The transportation of ore from the mines to the outside, that is a decision to transport maximum 48,000 MT of ore in a year. That means there is a perennial problem, there is a perennial mistake, because if the company can transport or dispatch maximum 48,000 of MT of ore in a year, how he entered the agreement with the contractor to produce and dispatch 60,000 MT of ore? So these are all 3-4 flaws were there in the contract. So we also highlighted these 4-5 flaws, so that in long run the company can, while modifying the contract, company can look into this clause. So that's why very important to if the company is going for the raising activity, the mining activity done by the MO or MDO, in that case, company has to see, the auditor has to see all the clauses set out in the mining agreement. I am giving another example. In one area, because mining involves drilling till putting the stock in the stockyard or at the dispatch point. So there is another point, transport, internal transportation. Means after raising, the contractor has to bring the ore to the stacking point, that is internal transportation. So contractor is getting the money for ore raising, internal transportation, unloading, and stacking. Then 4 activity for which the contractor is getting the money. That means contractor's price is fixed for these 4 activities. So I have seen in the transportation, internal transportation activity that is mentioned, the contractor will be paid for 7 kilometers of transportation. But when I visited the spot, I found total kilometer is 2.1 kilometer. That means the contractor is paid in the contract, original contract, for excess 5 kilometers. Just imagine how much money the company has paid to the contractor. Contractor to bring the material from the raising point till the OA bridge, then from OA bridge to stacking point. So there are the 2 types of transportation, coming from the raising point till OA bridge to stacking point, again going from stacking point to raising point to bring further ore. So there is a MGR system. So in that MGR system, there is a mention in the contract agreement, 7 contractors agreement, 7 kilometers. But practically, if we measure, that is 3.5 kilometers or 3.1 kilometers. That means contract is paid for excess kilometer in that raising contract or MO agreement. So we have to study when there is a raising activity to the contractor. We have to thoroughly study the MO contracts and how the cost is booked, whether tripping ratio is followed or not, whether company is penalized for the non-production, whether the company is being paid for the excess. Suppose contractor is removing extra overburden in comparison to ore. Then if the company is paid more for the ore, more for the overburden, for this transportation, for more low grade ore, but company is paying contractor high amount. So this clause has to be verified bit by bit, so that our audit objective will be achieved. So these are the regular points related by transaction, other related issues, and compliance and previous audit objection. Then come to these are the standard this thing. Then come to the cost sheet. You see, here this is the standard cost sheet, but I have made 2 columns. If the company is going for the own arrangement, which cost will be there? If the company is going to the MDO or MO mode, then which cost will be there, and which is applicable, which is not applicable. Basically, in this mining activity, there is no material, no process material also. Only the blasting materials, detonators and matrices, which are explosives required for the blasting. That's part of the consumable stores and spares. Then utilities, if there is own arrangement, applicable. MDO not applicable, because in MDO contract you have to pay for everything. MDO have to pay for everything, but here we have to we will have the own arrangement. Here what is happening? If the company is their own power generation own power generation plant, or company is procuring the ore from the distribution utility or the electricity company, then they are providing the electricity to the MDO or MO, and they are recovering about the meter reading. And your direct employee not applicable in case of MDO, because the mining activity MDO is responsible, and he will engage the manpower for his MDO activity. But in our case, if we are doing by own arrangement, there will be direct employee cost for the mining activity. .13 industry specific expenses like overrun removal, that is there, but in case of MDO that is not there because we are paying the contractor MDO or MO for overaging and overrun removal or combined cost. 1 point cost we are paying it to the contractor. Depreciation applicable, not applicable because company will engage its own infrastructure like dugliner, dozer, shovel, dumper, shaft or winder. But in case of MDO, that will be engaged by the contractor, so depreciation not applicable. And if you are going by own arrangement, only supervision and admin dispatch, oil bridge for the dispatch of the ore. OABG is required. Quality control department will be there. OABG will be there, and admin department will be there. And basically, these two things will be there. If the company is having their raising activity to the MDO, only quality control and exploration will be there because exploration of two types: one progressive and another is one time. So progressive exploration will be there. That is done by the company, whether it is raising through own arrangement or MDO, exploration will be there. So these are the things. So I have separated looking at the standardized item in the standard particulars in the average cost statement. If that is own arrangement, which cost is there, and if that is through MDO, which cost will be there. So that is mentioned here. Now come to the common cost. They are very vital. If the company has introduced the CO module, if they maintain the account through SAP and introduce the CO module, then I think this is possible. Otherwise, the company has to maintain manual records so that we can separate the cost. For example, quality control. You see, quality control are of two types. One is at the time of extraction of the ore, you have to find out which quality of which grade of ore or which quality of ore is extracted or erased. So accordingly, which the contractors will be paid, and it will be stacked accordingly. Similarly, another sampling at the time of dispatch of ore, because when the company will the buyer will take the ore from the stacking points, they have to also do the sampling. That is joint sampling. So quality control department is engaged for the production activity and selling activity or dispatch activity. So it should be part of if there is a production activity, there is a quality control, there is a separate line item we can put there. If the cost is material, if the cost is not material, we can put in the production overhead. Then sampling for the buyers at the time of dispatch. So that will be part of the selling and distribution overhead. So how we have to separate the quality control cost? That is also a challenge. So first of all, we have to find out what the cost of the quality control. That means the manpower engaged in the quality control department, the machinery engaged in the quality control department, the building of the quality control department, the repair maintenance of the building of the quality control department, the consumables or the chemicals used for the quality control. All the things you have to consider. And if we are finding out that suppose the cost is X, then we have to divide that cost X between two activity. One is production activity or raising activity. Second is your dispatch activity or selling activity. So we can derive a formula maybe through the tonnage of ore. We can because we cannot go for the production cost or selling cost. So we can apportion the cost of quality control between production and selling in the ratio of their quantity dispatched or quantity produced, between the quantity produced and quantity dispatched. So that things we have to see. Similarly, in the OA bridge, and suppose another example I'm telling you, so quality control. Suppose there is a for the selling overhead, you are apportioning certain cost, production overhead, then selling overhead. Suppose if you are recovering a certain amount from the consumer or the buyer, from the buyer towards sampling or quality control, then you have to deduct that account from the selling overhead. Otherwise, the cost will be as it is. Similarly, OA bridge. You see, OA bridge had the two objectives. I told you that when the raising contractor is raising the ore and bringing it to the raising ore and a separating the ore into different grades, then it is coming to the OA bridge for oilment, because on the basis of oilment of the ore, good quality of ore, the contractors will be paid. That's why that the first point where OA bridge work starts. Then at the second point, when the company is dispatching the ore, at that time the OA bridge works also be there. That's why the cost will be divided in two parts: one for the production activity or raising activity, second is for this dispatch activity. So OABs, what is the OABs? Suppose say OABs means OABs, then the DG sets or DG sets engage for the OABs, because that is a concurrent activity around the year, the dispatch around the clock. So DG sets, manpower, then suppose electricity consumption, then equipments and machineries, and all the things OABs, all the things depreciation is all the things will be part of OABs cost. Then it can be apart from the production overhead and selling overhead suitably, maybe on the basis of tonnage raised and tonnage dispatched. Similarly, another point is railway siding. That is very vital point for the railway siding, because in the railway siding, the cost will be there. The company has two dispatch points, one from the OA bridge and the second from the railway siding. In that case, what is happening? Company, those are taking the dispatch, those are taking the our stock from the OA bridge point, dispatch point. So they are paying their cost, they are paying their transport cost. Suppose we have entered agreement with one buyer to leave the stock till the railway siding point. In that case, from the stacking through the OA bridge, our own transportation, our own loader will go to the railway siding, and railway siding, our unloader or labor will unload the stock at the railway siding point. And from that, the company, the buyer will take in the take the stock in the rail or in the rake. So in that case, what will happen? The buyer will reimburse us. Buyer will reimburse us the freight cost, means transportation from the mine to the railway siding, loading and unloading costs. But some company, what they are doing, they are preparing one bill and putting in the sales, sale of ore, which includes the internal transportation, that means transportation from mining to railway siding, loading and unloading cost. So in that case, we have advised the company to separate the invoice. So how much they are getting from the ore sale and how much they are recovering from the buyer towards internal transportation, loading and unloading. Because we have to again compare the cost, how much cost we have incurred and how much cost we have paid to the contractor for transporting the ore from the mining to the railway siding, and loading unloading expenses, and how much we are recovering. So that is a control mechanism for which we advise the company to separate the invoice between the sales and other income recovered from the buyer. Then shared services. So that is more vital. You see, if the company has having 3 to 4 mines, or under one umbrella, one regional office or one head office, there are 3 4 mines. So there is a central focal point, means a guest house or your hospital or any education school or any common facility. In that case, the shared service will be apportioned to all the mines, those are dependent on this shared service suitably. Then exploration. The exploration have 2 types. One is core drilling blasting, another is your progressive exploration. Suppose company has done some exploration activity, and this exploration will continue for 3 to 4 years, because first of all, company, when it will go for the exploration activity, it will explore in a triangular shape, not straight to the underground of the earth. It will be in a triangular shape. In the triangular shape, they can find out in how much length and breadth of the ore is there in the next phase. So suppose and that on the basis of that exploration result, the drilling blasting will be taken place, and this exploration will continue. The exploration cost it will be for 3 to 4 years, because this type of exploration is done once in a 3 to 4 years. Most of the company, they are booking the exploration cost in 1 year. Because there is no any thumb rule to find out how much cost will be deferred, how much cost will be booked in the each year. So we have given one suggestion. You see what are the past trends, what the reserve in the expression, what the reserve percentage, and as per the mining plan, how much the reserve percentage will be excavated in next 3 to 4 years. So on the basis of reserve percentage found out in the expression and as per the mining plan, then we advise the company to defer the expenditure to the required year, not to book in the same year. Similarly, another common cost, that is a utility. Utility, you see, there is electricity, water, and fuel. Basically, if electricity you see into the account, I told you that when the company purchase the power, or company has the own captive power plant, or company purchase the power, there is one billing. Then company install the separate meters at each point, where from the electricity is drawn for the quarters, admin office, or the mining activity. In that case, on the basis of some meter, they recover the amount from the contractor, or they book the amount if that is for the quarters. They book for the employee cost, and if for the admin, then they're booking for the admin overhead. Similarly, for fuel, if the DG set is used for the oil bridge, the fuel, if the fuel is used for the DG sets engaged in the oil bridge, that is part of the selling overhead. If the fuel is used for the mining equipment, used for the raising of the ores, then that is part of the production overhead. So similarly, the fuel is also there. So if company install the CO module, will advise the company to link each type of expenses, individual expenses, and individual expenses to the machines and where it is used, to the cost centers. Say one machine engaged in the mines, so that repair maintenance will book to that code. That fuel consumption will be booked to that code. Depreciation will be booked to that code. That means we can derive at the cost vis-a-vis efficiency of the particular machine. Similarly, employee cost. If the employee is engaged in one cost center, the vehicle, if the vehicle is provided to the employee for commuting from residence to office, the cost of the vehicle, the fuel consumption by that vehicle, the suppose he is staying in the rent-free accommodation, the quarter cost or accommodation cost for that employee. If he is getting free electricity, the electricity cost of that employee. If that person is taking subsidy loans or any facility which can be tagged, that cost of that employee is part of the employee cost. So if the company has a CO module, then it will be fantastic, and we can give more and more result to the company on the cost control or cost reduction measures. And moreover, the efficiency, the cost of each activity, each process, each person vis-a-vis the performance of their performance or expertise, or the whatever the case may be, efficiency of that particular machines or manpower. Then come to the watch and ward. Similarly, in case of watch and ward, you can see the security guards are engaged in the lease area. So somebody is engaged to watch, to guard the stocks. Somebody at the OB level, somebody at the OB colony area, somebody in the admin area. In that case, we have to find out the number of watch and ward, and accordingly, as per the number of deployment, we can tag the cost, and we can book the cost in respective cost centers or respective items like selling overhead or production overhead. So these are the another 4 points. Mine project we have discussed. Then is sponsorship, periphery development, royalty, NMT, and DMF. Sometimes the company pays sponsorship. Basically, if the private companies, maybe they are paying for the some activity declared by the local political party or any need, if there's a government company for the need of the state government or central government, they go for the, like you might have seen the advent of our honorable Prime Minister in the airports, Ujala scheme. So airport area or petrol tank. Similarly, in our state also we have found the advertisement of our Chief Minister, honorable Chief Minister in different places. So these are been sponsored by the companies. So we have to find out whether the sponsorship really for the production activity or the main activity of the company. If that is for the main activity, then we can go for the we can agree with the company. We can agree with the company's booking to the cost, this sponsorship. Otherwise, we have to exclude it and we have to show it as non-cost. I'm giving an example. In our state, there is a school program in decided by the government of Odisha. So one mining company has given sponsorship for this school program, and this school were established. The facility in the schools were established in the area where there is no mining activity. There is no mining activity or no business area of that company, but they have booked the cost. So we have advised not to book that because that is not incurred. That is not incurred for the neither for the main purpose nor in the business area or the mining area that the company is working. So in that case, we have to exclude this from the cost. Because you see, our role is very vast. Because if we are not going by the true cost approach, then the cost at the mine level will be more. If the cost at the mine level will be more, then transfer price will be more. If the transfer price will be more, then ultimate consumer means steel industry or ferrochrome industry or any such industry, the cost will be more. If that is more, and if they are going by this activity, then ultimately we are the consumers will suffer, and the low man and the ordinary man and the consumer will suffer. That's why our role is very vast in the mining industry, because mining is the only primary area and primary point of the infrastructure activity. From the mining, then it will go to the steel industry. From the steel industry, it will go to the consumers directly or through other processes or through other products to the consumers. So that's why we have to be very cautious while seeing the cost, what are the cost booked in the mining activity, whether they're mining or non-mining. So periphery development. Periphery development means some company they are doing out of the CSR activity. Some company they are also because that is very less. So some company also other than the CSR, they are also doing some periphery development by like constructing the internal road, village roads, like tube wells, then electricity, free electricity to those villages, or the health camps, or any for livelihood they are giving some support, or self-help group they are giving some support, or they are going for the plantation activity, or they are going for kitchen garden, like the small activity they are taking up. So that is part of the periphery development, and it's very difficult to analyze each one by one expenses, whether that is meant for our core activity or not for the core activity. It is very vital. That's why we have in our farm level we have decided it will be difficult at the end of the year to analyze each one by one expenses, but we can see one expenses if that is within the in the periphery of the mines, that is in the mining area of the company, then blindly you can take it as cost. But if possible, we'll go for the test check. Suppose there are 7 line items, so 2-3 items we'll check whether that is for the main activity. But if the line item is more, it will be difficult for us to verify, but we can see whether the expense is incurred in the mining area. That is one thing. And mine closure, we have decided, we have discussed. Similarly, in the mine closure, we have to see, we have also given some qualification in last year cost report of one company, because though IBM has prescribed the progressive mine closure to book in to their accounts, they have not done the provision. So cost is undercosted. So we advise them to book the cost, because since the account was over and the board meeting has also approved the accounts, so that's why it was not booked. So the cost was undercosted for 2 years due to non-booking of progressive mine closure cost, not provisioning for the progressive mine closure cost as for the specification of IBM. So that you have to see very carefully. And sometimes what is happening, this IBM give the cost area wise, location wise, area wise, and on the basis of mining plan. So you have to also see that. Royalty, DMF, NMT we have discussed. So there are things. Next, come to our audit observations. Deficiency in the contract agreement. We have discussed. I have told you 3 to 4 points. The company, what you have to see during the course of audit, what you have to see, what are the loopholes in the contract agreement. I have given 3 4 examples. Then come to under recovery. Suppose company has some activity, company has given the mining activity, raising activity to the contractor, but some facility company is given to the company contractor, like electricity, like company has some water tanker or water sprinkler, water tanker, or company has crushing machine, existing crushing machine or screening machine. Company is incurring expenses, though that has to be spent or incurred by the contractor as per the agreement, but the company is incurring but not recovering from the contractor, not recovering from the mining operator. In that case, we have to see how much facility, what facility is extended to the contractor or operator beyond the agreement, and what is the value of that facility that we have to recover from each raising cost. Then excess payments, I told you, there is a specification as per the mining plan. There is a stipulation in the contractors agreement or operators agreement that this much of ore he had to give us with this much of overburden. But suppose he has raised more overburden but less ore, in that case he has been paid for the quantity he raised. Maybe overburden, maybe ore. He has raised fully. He has reimbursed fully for the quantity he raised during the year. Maybe overburden, maybe ore. So there is an excess payment because they have not. The payment was not in adherence with the stripping ratio as stipulated in the mining plan. That is excess payment we have detected. Then absorption for exploration cost. I told you in exploration when there is a triangular exploration, and that exploration cost had to be deferred suitably, but the company has booked the exploration cost in 1 year. It is a crores. It has an impact of about 100 to 125 rupees per MT. Then non-cost considered as a part of cost. We have discussed sponsorship or periphery development or any other cost which is not related to mines or not incurred within the mining area or lease area. In that case, we have to exclude those costs. Then we have also discussed under or overhead. Say company the company has not arrived at the normal capacity. Maybe raise 40% or 30% of the normal capacity. In that case, that's a stipulation how the normal capacity is arrived at. So in that case, if the with all the condition, if the condition is good, the company could have produced. There's every facility there. If the company not produced, there's no abnormal activity. In that case, the fixed overhead has to be under absorbed. Sorry. Then non-adherence to the mine closure plan. So mine closure plan we have discussed the quantum of mine closure cost specified in the mining plan as per the IBM, that should be provisioned in the accounts or cost accounts also. So these are the challenges. You see the very stringent challenges for the mining industry. Those are involved in the mining activity, either in the employment or in the audit or in the consultancy type. They can know there's a lot of challenges in the mining industry. Very difficult in the mining industry. That cost reduction. Suppose there's a heavy rain, there's a labor strike, there's a blockage of the road, then you have to engage your infrastructure. Despite of your production, the quantity not dispatched. So stock as lying idle as it is. Then there is a loss of your working capital, the loss of interest of working capital. So lot of problems there. So it's very difficult to find out the ways and means. So company have to go for the cost reduction. Suppose company is having 3 to 4 mines, then you have to relocate or deploy the manpower or relocate the manpower from one closed mine to new mines where there is a possibility of engagement. Similarly, the machineries, we have seen also Alok Dutta sir also highlight in his deliberation. I think he has a deliberation 13th of January. So how the idle machineries are, how the machines are remaining idle in some central government undertakings, central government companies, for which the production is not up to the mark and the efficiency is not up to the mark. So man power and machinery, we have to see how much we can reduce. Then government regulations. I have seen in some companies in Odisha Mining Corporation like manganese production, manganese mines almost closed since last 10 to 12 years. The stocks are remaining idle, but the company is incurring the cost. Government is not paying a single pie. The stocks are remaining idle. There is a watch and water cost. There is a fixed manpower cost. There is a electricity cost. Everything is cost there. Fixed cost is there, and the company is unable to sell the. Though there is a mining, there is a manganese stock, but the company is unable to dispatch the stock as per the government regulation. That is another restrictions. Then environmental factors. Suppose by any chance, if you are not added into the stipulation mentioned in the mining plan with regard to the environment protection or any environment, suppose you are unable to plant the trees, you are unable to go for the appreciation. In that case, there is rescission, then your activity will be stopped. Then market risk. You all have seen that is not consistent. There is always a market risk. So today there is a pickup in the ore market. The chrome ore, low grade ore also company is selling the low grade ore in a high price, and low grade iron ore also at a high price. There is a time I am giving you some example of 2015-16. There is a recession. The company was unable to sell the high grade mines, high grade ore also. So that is also market risk that is going, that is changing from time to time. Then social commitments. If the company is unable to go for the social commitments, maybe internal, maybe external. Internal means for the manpower, for the own laborers, own employees. There is a problem. So there will be stoppage of the mining activity. If the company is unable to do any peripheral development, the company is unable to do any social, fulfill any social commitment, and the company is unable to do any such of activity which is mentioned in the mining plan or the mining closure plan, then definitely there will be a stoppage in the origin activity. So these are the challenges for the mining industry. So my presentation is over. Thank you very much for the patient hearing. So if you have any question, you can put, and if you want to put a question afterwards also, you can also send me mail, so I can also respond to you. So I am very much thankful to the chairman, CMA Chaitanya Morir, vice chairman and chairman PD committee, my younger brother Arino Goswamiji, Nantisha, young dynamic, and Firebrand, regional council member from the Western region, and the young dynamic secretary Mir Vyasji, and in absentia our council members from the Western region and other regional council members. So I am thankful to the Western India Regional Council of the Institute of Cost Accounts of India for giving me the chance to deliver on this topic. And if I have tried my best to do the justice, tried my best to deliberate on the issues, challenges, and the mining activity to the best of my expertise and possibility. If I have missed something, please forgive me, because I am not expert. From the beginning, I have told you that I am not expert. If anything I left out, so I need your guidance, need your support to rectify myself, to add on anything in my slide. So thank you very much.
Sir, good evening. I just had a small query. Niranjan ji, thank you so much for your lecture, first of all.
Sure,
Thank you for taking out your time. This side is Devarajan.
Sure.
I just had one question, sir. You mentioned that cost audit, appointment of a cost auditor is a yearly activity. Is the test of turnover to be done every year? Because I was under the impression once the company falls under the gamut of cost audit, it is a continual activity.
No. If you see the old rule and the new rule, if the threshold limit, the company is active the threshold limit in the previous year. So once it is less than the previous year, if the turnover is less than the threshold limit, then audit cannot be conducted.
Okay, so that was the first question. The second question, sir, was this, that in for under absorption and over absorption, the guidance note basically says that it is the gap between normal capacity and the actual capacity. So
now,
between
in that case, no, there is no guidelines. There is no guidelines. You see, even also Coal India also not fixed any guidelines. But in last one meeting, because we had the lead author of Central Coalfield Limited. Earlier we had the lead author of SCCL and MCL also. So on that basis, we have also given some guidance in the lead authors meeting in Coal India, because you see that is mostly required. Otherwise, how can compare? How can fix the floor price? Now most of the companies are going for the auction price. No, very less linkage. If you are going for the auction price, then in that case you have to fix the floor price. And the floor price, if you put all the cost for the less production, then your cost will be more. So you will be unable to auction your own product. Suppose, for example, you have actually only 40% production, and you are booking the 100% fixed asset cost, then your cost will be more.
Sir, 1 minute, sir. 1 minute. My question was abnormal under absorption, over absorption is basically abnormal, and it will be a part of the reconciliation statement. However, the definition of under absorption or over absorption is the gap between the actual production capacity and the normal production capacity.
Yes.
Normal production capacity is defined as the previous 3 years turnover, average of the previous 3 years turnover.
Yes,
So
yes.
now, if there is the previous 3 years turnover are the turnover that actually has been achieved by the company.
Yes.
So now, if there is a small gap, and if the gap is because of an estimation gap, not because of any abnormal event like an accident or a strike or a closure of a plant for any undue reason, so is there still a need for an under absorption and over absorption is my question.
No, you are correct. You are correct.
Installed capacity, sir, आपका 1000 metric tons हो सकता है, और actual capacity आपका 40% है, then you don't you cannot recover the 60% obviously, because that 1000 metric ton would be a spread over 5 years. That point I understand, sir. My question is, as per the definition of CAS 2, normal capacity and the CAS 2 revised guidance note, normal capacity is defined as 3 years, last 3 years actual turnover, and the actual capacity. That was the only question, sir.
No, you are correct. As per the CS2, if you see the CS2, that CS2 was basically for the manufacturing activity, the company having the manufacturing activity or processing activity. And the mining activity is very peculiar. Mining activity is very peculiar. So that's why there is no standard rules to fix up the normal capacity. But what you are telling by the spirit of the from the academic point of view, that is correct. But company has to fix the normal capacity. If there is very less production than the normal capacity, then company has to under absorb the fixed overhead. That is our concern, because otherwise, if there is a 40% company actually the 40% of this is normal capacity, then how you can absorb the whole fixed cost to the cost sheet?
Correct, sir. I understand. Perfect. Yeah. Okay. Thank you, sir.
Welcome, sir.
Sir, I want to add one thing.
Sir.
In the mining sector, whether it is a coal or bauxite or lignite,
sir,
actual cost audit or the annexure to the cost audit has been prepared from the trial balance. That means the actual cost is booked under the different heads of the average cost statement. So the question of under absorption and over absorption does not arise. When it is arise, if there is some idle capacity or whether there is some difference between installed capacity and actual capacity for abnormal reason. That's why only that time we have calculated the abnormal cost and which would be considered in the reconciliation statement.
I think I agree with that point of view.
Sir, trial balance is separate. Trial balance, okay, we are taking from the chart of accounts or trial balance. But other than trial balance, we are also picking up some data from the primary records, or primary cost records, like consumption, capacity determination, the actual capacity, your stoppage hours, all the things we are also taking into account. So only that is incorrect. If you say they were taking the figures from the trial balance, that is incorrect, because trial balance is only financial figures we are taking. But other than financial figures, we are taking from the statistical informations, statistical documents, like your production maintenance, preventive maintenance, stoppage, regions, all the things you are taking from the statistical records.
Sir, I am just telling what is the practical thing going on in that industry. I am not
Sir,
talking about any theoretical part. What
Sir,
you have just told it, that should be, but in practice, it is not happening in any industry. In
sir,
any
sir,
industry.
Alok sir, I am auditor of 10 mines, private and government mines, and I have advised them, and they are following, and that's a good response. So practically, what is happening, that depends upon the auditor, that depends upon one-to-one persons. But my concern, if I am unable to produce the desired capacity, or my actual production is very less than the desired capacity, then I have no right to book all the fees overage to the cost of production. That is my concern.
In that case, the coal industry, in that case, coal industry is considering that in the abnormal cost. And that is treated as the reconciliation statement. This is done. This is going on in the coal industry also.
Sir, I have a small question, sir.
Sir,
Is coal under any price control by government?
sir,
Is coal under any price control? Price
coal.
by government?
Coal.
No, coal is not under the price control of the government. Coal
So
price is determined by the Coal India, and this is the notified price, and that has been followed across the coal industry.
That is market
Government has
driven.
no role to play in the fixing the pricing.
That
Obviously,
is
Ministry of Coal has given the consent to the pricing policy.
that means it is market driven. Is the price market driven?
No, this is not the market driven. The Coal India from time to time reviewing the cost of production, and on the basis of that they are deciding the pricing of the coal. And
Correct, sir. There are some private operators also.
there is the private player is not governed under the Coal India pricing. They are their own pricing policy, and they are doing like that.
So that is market open market price. This is
That you can tell like this.
company. See, Coal India has its own autonomy and other operators, other small whatever small medium whatever is there, they have their own autonomy to fix prices.
Yeah.
Thank you, sir.
Isn't that?
Thank you, sir.
Niranjan sir, just one more question. Niranjan sir, just one question.
Sir, I am not-
सर जी ये जो mine closure rights जो है, mine closure cost जो है, that is determined at the start of the operations itself, right? When you take the mining rights and estimate. So this cost even for financial reporting purposes is estimated and apportioned over the life of the mines, correct?
Yes.
So when that is so, that apportionment of the cost is a part of the production overheads in our cost sheet as well, correct?
Yes.
Yes. Okay, sir. Thank you.
Niranjan sir, good evening. This is Sushanto here from Kolkata.
Good evening, sir.
Let me first congratulate you for your wonderful presentation. I have a small query, sir, that although financial accounts consider royalty and DMF as a part of cost, but royalty and DMF are basically compensatory in nature. Rather, they are contributory in nature, because with that fund, when it is deposited to the respective authority, they are to make good the damage that is being done by way of mining operation.
Yes.
So in cost audit, do we consider them as a common cost, or we how to treat that? Because to my mind, this is not really a cost.
I am
It
coming
is
to your point.
something, it is not a cost which has been incurred in the course of operation. It is something that while carrying out the operation, something in contribution for the damage caused to the nature is being contributed to some other dedicated fund to make good the damages that has been that has taken place during the course of mining. So how do you see this point?
I am telling you, I am coming to that point. Royalty, DMF or NMT, they are not considered as a part of cost of production. They're part of selling and distribution overhead. And again also that amount also recovered from the buyer. So no, that is neither a part of cost of production or part of the cost of sales. But what is happening in now, those are the merchant mines or auction mines, mine owners. Now government has a feature stipulation that you have to pay the royalty at the highest grade. Suppose I am having rating up the 3 to 4 grades, say 40 grade, 50 grade, 55, 65, 4 grades of iron ore. But the company is paying the royalty at the highest grade of a royalty, say 65 grade ore. Because company cannot stock its stock beyond the lease area. It has stock within the lease area. So in that case, you have to create more space. So it is very difficult. And the company is unable to create the space to stack various grades of material. That's why company, and if they are asking for the government to go for sampling and grading of the ore, they are getting no, you have to keep like this, you have to keep like this. So they are penalizing. So now they are imposing the company in most of the states. I am seeing in the Jharkhand and our state also. So they are giving the royalty at the highest grade. So, but when we are dispatching the stock, we are recovering the royalty from the buyer at the grade which it is sold. Say I have paid the royalty at the grade of 65 FE, but when I have sold 40 grade, then I am getting the royalty of 40 grade from the buyer. In that case, I have some extra cost. That extra cost is part of our cost of sales. But suppose in case of a pellet industry, I am the owner of one iron ore mining industry and I own a pellet plant. In that case, what will happen? So I don't know what I am raising. I am selling, plus I am also transferring low grade of iron ore to my pellet plant. In that case, what will happen? For the pellet plant to the quantity of iron ore, I am transferring to the pellet plant. The royalty of such will be part of cost of production because transfer price will be decided accordingly. Similarly, if I am dispatching for the sales iron ores, that is part of cost of sales, selling overhead, and I will recover. What I will recover, I will credit to the selling overhead. So three things. One is if what I am giving to the government, if I am recovering that, then the cost is less. I will put in the selling overhead, recovery I will credit to the selling overhead. If I am paying a harsh grade of royalty, putting the selling overhead, if I am recovering less, then I am reducing the selling overhead. Second occasion. Third occasion, if I am paying the royalty for the captive consumption, part of cost of production. If I am paying for the sales, then part of selling overhead. There are three occasions the royalty undergo the treatment in the cost sheet.
Okay, as you said, Niranjan sir, in case of captive conjunction, you say that royalty is a part of cost of production, right?
Yes.
Now, my point is different. My point was basically that whether royalty is at all can be considered at all as a cost, although financial accounts consider it as cost, because this nature of expenditure, that is royalty, DMF, they are basically contributory in nature.
Suppose I have paid the royalty for the highest grade ore dispatch. Okay, but I am recovering less. So where this cost I will book? Suppose I have paid the royalty for the 65 grade of FE, grade of ore, but I have recovered the royalty for the 50 grade of ore. The differential royalty where I will book? That cannot be non-cost. If I have not paid the royalty at the higher grade, then I could have created more space to stack my stock. That is also cost. So without incurring the cost, without incurring the extra infrastructure cost for stacking of the ore, I have paid the royalty at the higher grade, though I am recovering at the lower grade. So this differential cost is part of the cost of sales.
So basically, you say, Niranjan sir, that the amount that has been paid on the account of royalty minus the amount that has been recovered from the customers, if there is any differential amount, so that is added up to the cost.
Cost, yes, yes.
Okay, okay.
Sir,
So just one more question before you wind up, sir. I'm sorry, but just one more question. These different grades. Just last one from my side, at least. Thank you, Niranjan sir. Thank you. Just 2 minutes. These different grades of products that you say, is each product different as treated as a different SKU, or is it a joint product or a byproduct?
No. You see, that's very crucial in the mining industry. You can neither you can say byproduct. There's a byproduct. Suppose you are by the process of separation, you found the ore grade less than 40% or less than 30%. That's not usable. If that is not contain any Fe content, that's not usable. But if that is sellable, say 40 grade or 50 grade or 53 grade or 63 grade, I don't know. In that case, you can tell it joint product. But I told you, it's very difficult to price that kind of ore. There was a time it was very difficult to sell the low grade ore in the market, neither export nor Indians consumption. But now the company, there's a peak in the market, there's a peak in the market. The company is selling the low grade ore as well as the high grade ore in the market. So when the company is selling the low grade of ore, then what is the cost? So earlier what was happening, the company is selling that there is zero cost. In the finance account, that was zero cost. That's a dump of ore in the mining site. Now the company is selling those ores. Again, during the current year, from the current year production, company is also selling high grade ore and low grade ore. So how will value that? So we have given one advice to the company. Either sell price, you take the sell price of 65 grade ore, say 10,000 rupees per MT, and 40 grade ore, 2,000 rupees per MT. So that is a 20-80 ratio. So you divide the cost of production between 20-80. Then it's good. Otherwise, without cost, how can you sell the product? Then what will happen? There will be a loss in the good grade of ore, and for the low grade of ore, there will be profit.
Correct.
So that's why,
correct. Right, sir. Thank you so much. Thanks a lot.
Welcome, sir. Welcome, sir.
Sir, in coal industry, overburden removal, is it across all mines? It is more or less same ratio will be there?
No, sir. No, sir. No, sir. That is not same across the industry, because that depends upon this overburden depends upon the environment area and the contents of the coal, and that will be detail will be given by our allocation sir while we will deliver it on the coal sector on 13th January. But to my knowledge, the strip ratio is not same.
Okay. Underground mining, is it confined to only coal or other? Because I am new to mines.
No, sir. Chromite mines. Mines is chromite.
Underground mining is confined to only, is applicable to only coal mines or other ores also?
Chrome ore. I have given the example in my deliveration. One underground mine is chrome ore. Second slide, I have given a picture of underground. You have to prepare the shaft, we have to prepare the slope, then we have to go to the bottom of the earth, then we have to go for the drilling blasting, then you have to pick up the material from the bottom of the earth to the surface of the earth, to the winder. I told you that.
Sir, ores such as iron, copper, bauxite, manganese, there are no undermining. There is no undermining.
Desai sir, this is a never-ending discussion, but you'll realize, sir, Niranjan sir is talking since interacting with us since 2.5 hours now.
Correct.
So let us spare him. I'm sure that he has
Okay,
shared
sir.
his number also, sir.
Done,
Uh,
done. Done, sir, done.
So you
Sir, you
can
can use this.
personally, I know him personally, sir. He will help each and every members with their assignments. He has helped me in past. So with this, I request all the members, if there is any pressing short question, you can ask, or else let us move towards conclusion, sir.
Okay.
So I understand not very long questions there. So Niranjan sir, let me have a pleasure of this vote of thanks.
Thank you.
I want to thank our chairman Chaitanya sir, and also our PD chairman, especially Arindam Goswami ji, for arranging this kind of session whereby so many senior members are interacting with the faculty, and faculty also frankly sharing all the intricacies of these sectors and all. And what a opening batsman we have in form of Niranjan sir. He has hit all the balls to the boundaries, and with this, I'm sure that sir, 9:30 and nobody is leaving. There are more than 50 people who are glued to this session. It shows how much we have served. And also, I thank all the participants. And at the last, our own Niranjan Mishra sir, he has been pioneer in many areas where practicing members are doing good. So with this, I thank all of you and the staff also for arranging this session at late hours. And
Thank you,
I'm
sir.
sure that this whole presentation video also will be posted. So share it with your friends who can take advantage of the same. So with this, Niranjan sir, once again, thank you.
Thank you very much. Thank you very much. Thank you very much.
Thank you,
Thank you, sir.
Niranjan sir. Thanks a lot.
Namaskar.
Thank you.
Good night, Niranjan sir.
Namaskar. Good night. Namaskar.
Good night.
Thank you, sir. Excellent presentation.